my window.
Hello, traders. Gary Wagner with the Gold Forecast here. It is 10 a.m. in Honolulu, Hawaii, April the 15th, Friday, and this is the Daily Report, our weekend review. What a week we have had. We have gold trading at record prices, currently 1486, 1487. We are looking at our daily chart with channel lines, candlestick, and Elliott wave. Here's what we are seeing. Of course, we have been hitting consistent record highs for the better part of this week. As a review, we have wave one. This begins the initial impulse phase. As you can see here, this happens at around 1380. We then go into our corrective wave. Our corrective wave is going to be right here. This is wave two. And that consists of basically a 3 count. 1, 2, and 3. And then we go into our latest impulse wave. That is wave 3 right here. So when we look at that, we are expecting, and I say expecting because we could be getting anything, but we are looking at what I believe will be a 5 count. So on something like a 5 count, when we take a look at this entire impulse wave, this is going to be 3 here. Right now, what we have seen is our 1, 2, 3, 4, and right now we are in, I believe, wave 5. That's the minor count within this wave 3, which is a intermediate wave, of course, as our last wave of this impulse phase, which is wave 5. What a week we have had in the market. It has been just tremendous. Of course, we took a position early on. We got in on this particular bounce earlier this week, and we have witnessed some significant returns on that position. On today's report, I will talk to you about my outlook for next week and talk to you what I believe we will be seeing in the next upcoming month. All here on today's daily report. Now, another way to look at the market, and sometimes when I want to take away all the clutter of the market, I go to a simple line chart. And that simple line chart that we're looking at right now is a 240-minute line chart, so that each point that it will represent going to be 4 hours in trading, and then it will draw a line to the next point. The thing that we find, at least to me, most apparent were a couple of tops that we had to overcome. This, of course, was our major top. This was that 1440 area. And you can see that when the market did take that out, it took it out with a passion, of course, came up, of course, and then made this new high here. This was that former high that we had earlier this week. It did come back down. We did get around a profit taking. And now we have the market absolutely and utterly above that breakout point, that target point. Now, what that tells me is that, as I spoke about over the last couple of months, fundamentally, that perfect storm that has been building, that perfect storm is absolutely here. You can see it in the current price of gold. We have multiple conditions which are still found within the entire market sentiment itself, whether it's new inflationary concerns, the rising price of oil, which of course is causing those, the concern of the European debt, which has resurfaced. Of course, we have QE2, we have a monetary budget here in the United States, which is printing dollars, which is creating a greater deficit, and then an argument now, not an argument, but impasse, so to speak, between the Republicans and the Democrats as they hammer out some sort of revision on our budget deficit in which the sides are compromising but certainly not agreeing. And so to me, that is an indication that you've got all of these factors kind of coalescing together. And when they do, this is the outcome. So what am I looking for next week? Well, I will tell you this. My sentiment right now is that as long as we can maintain ourselves above roughly the 1478, this one particular area right here, I think that that area, if it can hold above this as we open on Sunday and go into our trading week Monday and Tuesday, if it remains above here, the prognosis is extremely bullish, and I think that we're probably going to head into the $1,500 area. Scenario number one. Scenario number two is that as the market comes in, there is another round of profit taking. Let me blow this up for us just a little bit. And there is another round of profit taking that takes us below this particular area right here, this 1475. I think that if we see that, we might come back down and test this particular area, which is around the 1460 area. So that in terms of where the marketplace might go, I do think that we've got a critical set of tops here that used to be our resistance areas that I believe now have become basic support areas right in here. And so we're going to have to watch over next week to see how it reacts right in this particular area. Traders, we have had a week unlike most weeks. We, of course, have a long position. You can see that from the members portal at any time and where the stop is. I've just kept the stop very, very loose as we let the market run because I do expect wild volatility to enter the market. It hasn't been as volatile as I thought it might be, but I did expect to see some volatility enter into the market. Now, we will look at this point to shore that particular stop up. We'll do that on Sunday. I want to see how the marketplace opens, and we will also look at scaling in and scaling out of this position. I will talk to you about various strategies that professional traders use as they enter and exit trades. They simply don't buy everything at once and sell everything at once. Rather, they typically scale in and scale out. And we'll spend a few moments next week talking about that. In essence, what we are going to be talking about is basically called an inverse pyramid. Now, on an inverse pyramid, typically what people will do is they will buy, say, 3 positions. And then when the market moves up, they will add another 2 positions to that. And if the market continues, let's say, to move in the direction where it is moving higher, they will then add another position. All right? Now, this is the proper way to scale into a position, the inverse pyramid. Why? Because you have the largest number of positions at the best possible price. The incorrect way to do it is to simply buy a position. As the market moves up, you would add another couple, and then the market moves up, you add another couple positions, 3, and the market moves up, and then you add your last rack, which would be 5. And this pyramid here is going to have, as you can see, the largest or greatest number of positions at the worst possible price. So for that reason, professional traders will always use this. In other words, they will begin with a base, and as they add those positions, each time will get smaller. In the same way, as they leave the trade, they will then scale off 1 position, then they will scale off, they'll scale off 1, then they'll take off 2, and then they'll take off 3. So that as they're scaling in and scaling out, and we'll talk about direct strategies a little bit more next week, but I wanted to spend a couple of moments and talk to you about the whole concept of scaling in and scaling out of the market. This has been Gary Wagner, wishing you as always good trading, and this week I got my wish. Have a great day. We'll talk to you on Sunday for another daily update. Bye-bye.
Many sights to see, and when I look in my window, so many different people to be, that it's strange.